Well, g'day there, everyone scattered around the world. It is James here with you on behalf of Pivot Point Trading. What I wanted to do in this particular video is just alert you to some of the, advancements taking place in terms of breadth on the Russell, but also more importantly, just what's going on with the Dow Jones Transportational Average. It has been, to a degree, along with the Russell, a leading indicator for the other three equity markets. When I say other three, I'm speaking about, or at least referencing, the industrials, the S&P 500, and also the NASDAQ. The transports, however, the Dow Jones Transportational Average, is something that I've been keeping a close eye on and have been waiting for a certain pattern to establish itself. Well, this pattern, which I've been waiting for the market itself, the indice, to establish, it's actually more or less formed at the moment. And that's why I'm making this recording as at Wednesday, at the close of trading on Wednesday. It's what we call a double top, and it does lead into a reversal. The reversal which I'm looking for is really the continuation of the long-term trend on the Dow Jones Transportational Average. First of all, this is what we call, again, a double top. But when we trade double tops, we always want to wait for confirmation. Just because we see the double top setting up, we need price, of course, to confirm confirmation is achieved or it is attained when we break through the neckline of the actual double top itself. So as you can see, I have this trigger on the transportational average down here, 7,557. We're currently trading at, or we closed at on Wednesday at 7,756. So we're about 200 points away from confirmation being achieved. But in, the more macro picture of this chart, you can see once again, we're just continuing again, the series of lower highs and lower lows. A lot of people got really excited by this bullish rally, which has more or less coincided with the equity markets rally. However, it started on the transportational average in mid-January rather than about mid-February, as we've seen on the other three equity markets. So we've seen this bullish move, this counter-trend movement. It's always most important to understand the macro picture. What is the bigger trend direction? That's why, again, I'm paying so much attention to what's happening at these critical areas of resistance, which we seem to be reversing off from on the industrials, the S&P 500, and most noticeably the NASDAQ at the moment, because it sets the tone for where the majority of stocks are going to move on more so an intermediate time frame, and definitely more so on the macro time frame. So where is this particular market or set of particular markets moving further into 2016 and most likely into 2017? If the Dow Jones Transportational Average gets a push below, again, around 200 points from where we've closed at on Wednesday, well, this is going to be a major problem for the bulls out there who have bought upon this slope of hope rally. As it has occurred and repeated itself time and time again, the people who buy in the face of a primary bearish trend ultimately have to resort to closing out those positions, and the trend itself, which is down, essentially rolls over and continues, i.e. lower prices ahead. We've actually pushed below the 200 simple moving average. You can see that really well defined double top. This isn't really an immediate sell signal just to say, look, we've closed below the 200. That doesn't really mean all that much. It's better to wait for confirmation, but when we go through, again, the nitty-gritty of it, we're simply interacting with that 50 exponential moving average. A lot of people are calling this new bullish trend in the transportational average, as they have on the other three equity markets, and unfortunately they just misinterpret the data itself. This isn't a true signal. We're not trending, or at least we're not trending to the upside. This is just a correctional move again back into those declining areas of resistance. So you need to understand, or at least differentiate between the two in this particular scenario. We've got the oscillators again indicating weakness. You can see the Stokes, it's still got a long way to go. The RSI is somewhat close to oversold, but when we align that with the divergence which has taken place, and again, I've been speaking a lot about divergence on the industrials, the S&P and the NASDAQ. NASDAQ has reacted most severely as at the close on Wednesday, but the Dow, in my opinion, and the S&P 500 will ultimately move back into a closer percentage pullback to what we're currently seeing, or at least the divergences between the three markets. As a percentage term, I'm looking for, again, the Dow and the S&P to catch up to the NASDAQ. But when I go back out on the weekly chart, this is where, again, it should really drive home, the severity of this short-term double top at this resistance level, because, again, it's coinciding with some major crosses taking place in terms of the overbought, overextended, over leveraged type of move to the upside, which is naturally going to correct itself when we come all the way back down to 6,500. Have a look at the Stokes. It's just giving us that cross. We've got multiple points of negative divergence or bearish divergence on the RSI. And the MACD, the histogram has turned down. That means that the two signal lines, or at least the fast signal line, is converging back towards the slow line. So momentum on the weekly and the daily chart is shifting, or it has shifted. And this is just the beginning of the selling wave. What you have seen over the past 2 weeks in the transportational average, it isn't going to be a whole lot in a number of weeks, if not months, when we see the sell-off all the way back down and most likely overshoot these levels down here at 6,500 on the transportational average. A major warning which I'm giving you right now, do with it as you please, but it's something to take serious note of and to at least think about. Let me just think about also the Russell 2000, not think about it, but at least show you what's going on. This is a really good, I guess, signal of breadth in the market. Instead of just looking at, say, for instance, 500 companies on the S&P 500, or maybe looking at 30 companies encompassed within the industrial average, or 100 on the NASDAQ, depending on which composite you're looking at. Well, when we look at the Russell, we're more or less looking at 2,000 small to medium cap or mid-size companies listed on this particular indice. Now, what is interesting to note, this is just sort of a curveball, when the S&P was within 2% of its all-time high, I think it was closer to 1.5%. So when the S&P itself was 1.5% away from its April-May 2015 high, well, less than 12% of companies were at a similar level or higher. Less than 12%. Now, that is telling you that the majority of stocks, 88% of stocks, are simply not with the move or not with this bounce on the S&P 500 on average. But when we look at the Russell 2000, have a look what's happening here. Again, and similar to the transportational average, we've got the consecutive series of lower highs and again lower lows. We've seen the Russell have this major push back up into and very close, if not overshooting, our trend line, which we've had. A lot of people have got very excited to say, look, we've broken the bearish trend line, everything's okay. But then unfortunately, once again, reality starts to set in. I've been speaking about openly and privately bearish divergence. All right, you've got the stochastics showing up. This is just not on a sort of a weekly time frame or a number of weeks. We're talking about 2 months of negative divergence setting up. The MACD's crossed, the RSI is tanking, so is the stochastics. On top of that, we've got the candlesticks, which are very, very important. If I zoom in and show you these, we've got the evening star reversal taking place up here. I've referenced the number on a number of occasions, the amount of spinning top candlesticks, the shooting star types of candlesticks, the long white Morobozu candles with simply no follow through, which ultimately get rejected. Well, now we're starting to see the roll. You see this one black crow right here. You see another one black crow right here. And then when I pay attention to volume, I mean, has volume really been with this bullish advance? I mean, just look at the slope on average here. It's declining as the market has been moving higher. A major warning signal, if you pay attention to the red bars at the moment, they are seemingly spiking. Not the biggest volume advancement, or at least an expansion in volume, I must admit that. But in terms of the red bars, what we're seeing in terms of the sell-offs, against those advancements with no follow-through, and in the face of divergence in the bearish trend, it looks as though volume is very firmly on the bearish side on those pullbacks. If I change to the weekly chart again, does this look like a bullish cross which is about to take place? Or is this telling us that, look, we've rebounded back up into these areas of overhead resistance and we're set to oscillate back down? Which direction is the trend moving? Unfortunately, the trend is down. It still is down. And if anything, we've come back up and we've just retested this old support as new resistance. And we're starting to see the pullback, or at least the push away, up from these levels, which I've sort of diagnosed or at least forecasted all the way back in February 2016. So it's always good, once again, to sort of withdraw yourself from market noise, or at least the sentiment which is going on in the market at a certain point in time, and really have, I guess, a game plan or a blueprint of where markets should be moving to, and what pivot points. Pivot points are really important. That's what I I speak about a lot. Pivot points are more or less interchangeable with support and resistance. But to understand pivot points and also macro pivot points, so when I say macro pivot points, I'm talking about the major areas which we're looking for on market. Say these red boxes, for instance, which sometimes I draw. A good example of this is if I bring back up the Dow Jones transportational average. If it wants to work with me, let me just do this one more time. DJTA. See this red box? There's two pivot points here which I've been paying attention to, 7.7 and also up at about 8,000. Well, within this red box and within the two pivot points, we get the chart pattern, which is the double top at the right location where it derives its meaning from. And the probability of expected moves above or below certain conformational triggers, which is what I'm all about, go up exponentially. So if you're looking for a way to actually understand technical analysis and apply it, there's a lot to learn if you're sort of sitting there scratching your head of saying, well, I don't completely understand what you're saying, but it seems as though you're making valid points, right? And you're sort of seeing, I guess, the evolution of the analysis day by day. I know I don't put videos out every day, but it's important to do it when the underlying, I guess, technical footing of the market is starting to shift. And again, we've been waiting for this for quite some time, and it is beginning to happen. Now, quickly applying this to the major US equity markets, you can see right now, just look at the exponential moving averages and ask yourself, well, what is the slope? What is the slope of the exponential moving averages? Are they sloping up, indicating a bullish trend if we were in a bullish trend? And I'm not talking about looking back at the beginning of April or even going back to February. I'm talking about what are they doing now? If you pay attention to the 10, it's sloping down. If you pay attention to the 20, it's more or less flat. It has taken a little bit of a nosedive over the past 2 days. And the 50s, it still has a slight upward slope. So, if you're trying to make sense of any of this, this is how we do it, all right? Definitely as swing traders as well. Generally, when you get reversals, when you get into these shifts at macro pivot points, right, at very important tipping points in financial markets, the price will come into the 10 or the 20 and it will bounce, right? It can do this a number of times, but ultimately, price will break both the 10 and the 20. Then what happens? Price will gravitate back down to the 50 exponential moving average. So as a lot of people are looking at this chart, and I myself find myself in the long-term bearish camp, all right? I'm not shying away from that whatsoever. It's very openly and publicly detailed on this YouTube channel. Short term, and even in the face of this pullback, I can sit here relatively confidently and say that, look, I'm expecting the S&P 500 to rally, right? Logically, I can sit here and say, well, I expect the S&P to more or less hit the 50, which it has very close to have actually occurred on Wednesday, but to see a short-term bounce, right? That is completely normal. However, that bounce, which I'm assuming is going to take place, it can take place at the 50, and that's more or less where I'm expecting it to. It may set up from about the 2035 area, 5 or 10 points below the 50 exponential moving average. It doesn't really matter to me because it's just a couple of points, and I'm not trying to pick and choose my intraday levels as a day trader. That's not what I do. But what I will say is that I'd be very, very surprised to see the S&P 500 get back to 2,100. I think we're operating in many ways or in many regards on a limited oxygen supply. And then ultimately, we're going to say goodbye to these levels for a very, very long time. Now, again, not to scare anyone, that's just the severity and the reality of the current levels we're dealing with technically. So I expect the 50 to hold. It is going to set up a lower high, and then that is probably going to set up again some form of a bigger right shoulder within a major macro right shoulder of a larger head and shoulders topping pattern. A bit of a sort of an inception style theme going on at the moment, but that's generally how these things will work out. We may just completely break. If that's the case, I want all three markets in agreement below my macro triggers, which I've pointed out very specifically in pro, and I have alluded to them even in this sort of public domain on my YouTube channel. But I will be looking for those 3 of 3 confirmational triggers before I start adding to my already hedged position, long-term hedged position on these markets. But if I just start to show you again some of these oscillators, we've got negative multiple points of negative divergence. But again, on the equity markets, the weekly chart, have a look at this. Just like we've done leading up to the top in 2015, we got the cross and we saw the sell-off, right? Again, when we saw the slope of hope, or at least the bounce towards the end of 2015, what happened? We got the cross and we put in that new lower low, right? And again, we've still established a third lower high. And here we are again with the cross. I'm expecting it, if this is a genuine cross, and I expect it will sort of, the outcome will result in that. I'm not sure how much longer we're actually going to hold above 1,800. Now that's somewhat scary, but again, we're a long way away from 1,800, and we're getting all of these signals saying, well, be prepared for the reality that the markets are headed this direction. And again, I'm alerting you to that. The Nasdaq has been the weakest of the three by far. If you pay attention to the high, it was put in, I think, the month after. It was in June 2015. We do have an established lower high. We have an established lower low, 2 consecutive lower lows, and now a third lower high. This, people are calling it consolidation. I understand why. People are saying, look, we're moving sideways, and that is entirely true. Well, historically, markets don't really move sideways for all too long, right? We're sort of at the end of a consolidational type of phase, right? Either this is a consolidational phase, which is ultimately going to break itself to the upside. I think that's quite stretched at the moment. Otherwise, in due course, people will stop calling this consolidation and they'll start calling it distribution. Major difference between the two. Consolidation is a continuation pattern in the underlying trend. Distribution is generally the end of a bull trend, where again, informed investors are distributing their positions to, I guess, retail investors, right? People who are looking at this market and expecting a pretty prosperous 2016 and 2017. So if we do crack these levels, which I'm expecting we will at some point later in 2016, well, then this clearly becomes distribution, and it all comes together very, very nicely. But look at this. We're about to get the cross on the Stokes. The RSIs are relatively weak. The MACD is already starting to turn down below the neutral line, and the histogram as well has already got 3 consecutive lower towers. So I mean, the momentum itself, it's telling you right now, look, we're moving. We're pushing away from these upper levels. Now, I'm still open to the likelihood that this gap is going to be filled, and I've seen through comments that a few people are saying, look, given the price action we've seen over the past week, 2 weeks, I don't think it's going to fill. And that is their perspective. I understand that. I still think this gap is going to fill. I genuinely do. The reason I say that is because the way I see the NASDAQ at the moment is that there's a very good chance it's going to pull down to maybe 4.5, 4.6. And then this is going to establish a short-term higher low. All right. From this higher low, a lot of bulls are going to really get excited to say, look, we've got 2 consecutive, or we've got the first consecutive higher low. This is the beginning of a new bull trend. They're just, completely wrong. But people are most likely going to jump in, and we're going to sort of struggle to come back up. We may just eke out a relative high compared to the peak that we put in April. That will close the gap, and then that's it. It's over. So, I mean, it's either that's scenario 1 on the NASDAQ, and obviously that's going to align with the Dow and the S&P 500. Otherwise, we're coming down and it's sayonara. I don't know. I can't sit here in good faith and tell you which one it's going to be. But what I can do is, again, go back historically, which I've done, literally spending hundreds, if not thousands of hours back trading, really through the beginning of the data, which I can accumulate through this charting software, and just see what's worked, what signals to pay attention to in terms of price action, Dow theory, and also some very long-term moving average crosses outside of the 50 and the 200, which a lot of people are referencing at the moment. They say, well, look, the 50's back above the 200. This is bullish. Well, yeah, that's the case in the Dow, the S&P, but it isn't on the NASDAQ, and it really just doesn't take into consideration, even if you look at the crosses, the unfortunate event that we're still putting in lower crosses as well across these actual markets as well. I think it's a very unvalid signal at the moment, a signal which has produced a lot of misleading and deceitful signals in the past, and unfortunately it's going to produce the same again. But I mean, you have to look beyond a simple 50 and 200 cross. I mean, you can go back and do the analytics behind it all and say, well, what's worked in the past and what are the probabilities? But in my personal opinion, I don't find this signal to be all that validating. I really don't. Just as it gave us a bullish signal or generated a bullish signal in December 2015, well, it didn't really do a good job of forecasting a sell-off through January and February, which again we were on top of completely. So just be careful if you're subscribing to sort of any of those thoughts on the markets. The Nasdaq at the moment is below the 200. It's below the 100. It's below my macro trigger for the Nasdaq. However, the Dow isn't below that macro trigger, nor is the S&P 500. We are pushing closer to it. And if those levels are validated, that is where all of my trend following signals turn hard negative. And again, I'm sharing that with you for your benefit, just so you know, to keep you in the loop, to say, well, do with it as you please, but be very, very, careful around these signals, because, the likelihood of further downside, or at least material deterioration in price action, really extrapolates, or at least it explodes. To the upside if these levels are really triggered. And you can see that they're quite eloquently placed. On the Dow, they're in between the 100 and the 200. That's not me getting arty or creative about it. That's just where it is, as per other charts. But we are still quite a way above the 200 and the 100. Technically, we are in some form of an accumulation phase, because price is above the 100 and the 200, but the 100 below the 200, so it's really a false signal in and of itself. Same on the S&P 500, price is above the 100 and the 200, but the 100 is below the 200. So this isn't technically aligned for a bullish continuation whatsoever. It's in this accumulation phase, which will ultimately fail, and that's what I've been expecting for quite some time. And again, we're starting to see it right now. However, just to sort of surmise what it is I've said. Although we're seeing breakdown in terms of breadth on the Russell and on the Dow Jones Transportational with that double top setting up, just be open-minded to the fact that markets do not move exponentially up without having some severe pullbacks, and they don't move exponentially lower without having some pretty strong counter-trend rallies. And that's what we see in financial markets. And I assume we're going to see a slowdown towards the 50 exponential. That's going to set up a short-term little bounce opportunity. I will not be taking those bullish trades. But if we start to see a bounce and we see again the establishment of a double top up here, and again, I can only assume that this is a similar structural setup to what we've established in November and December, well, then that's going to be the major sell side trigger, which, when we look back in time, we were just waiting for throughout February and March and April, and being really, patient and just disciplined in our approach to actually putting money to work in the financial markets, because you really need to learn how to pick and choose your entries. It's really important that you just don't, sort of wake up one day and say, look, I'm feeling bullish today, so I'm going to buy the market, or vice versa. Look, the market's down, so I'm just going to start selling. You really need a detailed and in many ways an articulate approach to the markets, and just to really just feel comfortable and to have, conviction and assurance in your analysis and where you believe financial markets are moving. That's really what I wanted to say at this particular moment. I hope you all have a really nice Wednesday evening. Outside of that, just be really careful out there. I'll keep updating you with advancements, but I think this is really the beginning of a much bigger move across all of the US indices and the majority of stocks traded within them. All right, this is it. I mean, history suggests that this is going, or we are in the process of a topping pattern right now, and just be very, very careful if you find yourself buying this market at these levels. I think that's all really I wanted to say. If this has been helpful, give it a thumbs up. Outside of that, everyone have a fantastic Wednesday evening. I'll be back with you probably next week, if not definitely or certainly this Saturday in Pro. All right. Outside of that, everyone, I will see you in due course. Goodbye.